Hi, welcome to Business Influencers. I'm your host, Chris Salem. Hope everybody is having a great week. Again, we are excited that you are here and found us here at the TAL Radio platform. We're also encouraging our listeners to also follow us on YouTube with the Touch of Life Foundation for TAL Radio. Business Influencers has been there for over 4 years. And also you could follow us on Apple and Spotify. Again, if you like to listen to the show in audio format, you could go ahead and do that via Apple and Spotify, and then the video portion both on YouTube and the TAL Radio platform. So if you are new here, welcome. We are excited to have you here, and we encourage you to check out many of the great podcasts that are available on the talradio.org radio platform. And I want to give a shout out to our sponsor, Alumni Direct. Alumni Direct is a social media community platform dedicated to bringing alumni together from all different generational types and an opportunity to meet new people for the first time. Now, it is a membership program, taking out all the noise out of social media. You get to generate genuine and authentic relationships with the people you choose to interact with. If you'd like some more information about Alumni Direct, check them out at alumnidirect.com. That's alumnidirect.com. Well, I am excited today. We are going to be talking about what credit markets reveal about success before everyone sees it. So this is really important for those out there that where this will impact not only you, but your business or businesses. We're going to be with our subject matter expert, Daniel Byrd. He's a private credit and distressed investing expert with over 25 years of experience across global markets. He has worked at institutions including Merrill Lynch and Hayfin, specializing in complex credit restructurings and special situations. Daniel helps investors, family offices, and founders navigate risk, liquidity, and long-term value creation in an increasing complex financial landscape. And without further ado, we welcome Daniel Byrd to the show. Daniel, how you doing today?
I'm great. Thank you. Thank you for having me.
Thank you for being here. So, Daniel, we always like to start off our show about, you're going to be talking about, what the credit markets reveal and what, business owners and anybody that could be impacted by that should, know before it happens. Give us some framework behind that, like, your backstory, what led you up in doing what you do in this area.
Sure. So I've been involved in credit markets for, my whole career pretty much, starting back in, the mid 90s, after college. My first job on Wall Street was at Credit Suisse. And there I was doing more of a banking and advisory role, right? Working in leverage finance and corporate banking. And that was, really making and arranging loans for businesses, a lot of buyouts and other businesses that Credit Suisse did banking with. I transitioned over time into more of a markets role. I just thought that was more interesting, a little bit more fast paced. You got to invest your own money or your money that you were representing in the markets. It was a little bit more tangible in terms of an impact. So I moved into there, early 2000s, and I've been in that in that kind of ever since. I find it incredibly interesting. We get to deal with a lot of different types of businesses at different stages of their evolution. Some are very mature, 100-year-old businesses. Some are very young in healthcare and pharmaceuticals and things like that that are discovering new pharmaceuticals and drugs and things like that. So, across the whole spectrum, big companies, small companies, different sectors. It's a very, very interesting role.
Thank you for sharing. I love that. And if, as we dive into the topic here, in terms of like, if you, no matter what kind of business that you're in, it depends on an industry that you may be in as well. What do business owners or leaders, should be knowing about before it happens about the credit markets? What should they be looking at?
Look, I think there's a few things to watch from a macro perspective, right? That kind of impacts most businesses. Borrowing rates obviously have an impact on any business, right? Where you can borrow money, for a small business where huge companies can borrow money to do big things like build data centers and do acquisitions and things like that. And those rates fluctuate, and the Federal Reserve in America has a lot to do with that. The ECB in Europe has a lot to do with that in terms of setting reserve rates and things like that. So watching those rates, I think, is very interesting. The Fed tends to be a little bit reactionary rather than a predictor sometimes of where markets are heading. So you have to take that with a grain of salt. But look, if the Fed is in an increasing rate cycle and their outlook is to increase rates, that means businesses are probably going to slow down a little bit. That's the purpose of raising rates, is to put the brakes on the economy a little bit. So recognizing that is happening in the market. Sometimes it's your own business, and sometimes it's your customers' businesses that will be impacted. If you're a consumer-facing business and rates are tightening, that might mean just general belt tightening at the household level. And if you're selling a certain type of commercial product, maybe that has an impact. So those macro factors, I think, come and will impact every business. There are other factors out there, financial stress. Default rates among in the credit markets, whether that be in loans or bonds or the high yield bond market, for example. Those are interesting things to watch. Again, they're another gauge of where the economy is heading in terms of financial health. If default rates are spiking, it means a lot of companies are having trouble. That means probably the economy is relatively weak. So good things to keep in mind. But I think watching the big kind of macro signals, default rates, where interest rates are, I think get you 90% of the way there.
Absolutely. Do you recommend that, again, there's a lot of patience that I would take, that you have to be patient in this process. And I'd love you if you could expand on that. Is there certain resources that you may recommend that, a lot of these owners may not be an expert in the area like this, like you? Are there any resources they should be aware of that can kind of give them, enlighten them in that awareness of where things are, like on a macro level?
Yeah, sure. Look, I think, to track the big macro factors, these are the basic resources in financial markets. It's the Wall Street Journal,
Yep.
any Google or Yahoo Finance type web page will get you most of the way there. There are very specific publications that focus on the debt markets or the distressed debt markets, for example. I think that's probably a little bit too much unless you're really focused on the market 100%.
No, I agree. So like in this case, I usually get either some alerts, you could have set up Google alerts or having, something show up in your feed in terms of, if something comes up that, hey, that could be important, it kind of just keeps you top of mind if it does, impact your business one way or the other.
Yep, exactly. I mean, look, I have an alert for anything that comes out of the Fed, for example. So, I'm the same way. And then there's a few big institutions that specialize in credit, right? PIMCO, for example, is a very famous fixed income investor. So I have alerts for things coming out of PIMCO. And a few others, and those get me the majority of the information that I need. You don't need to subscribe to anything.
Well, no, that's fabulous. I love what you shared there and what you did. So if you can maybe break down a little bit of the process, in terms of patience, discipline structures, anything to do with, how we see things from a mindset perspective, anything that you can share that can really help these leaders and owners in terms of how they can see their personal and business long-term success.
Yeah, sure. Look, I think the credit markets are interesting, right? I mean, I would say most personal investors, the things that they track the most are equities, right? And turn on CNBC and that's all they talk about is equities, or Bloomberg or whatever. And that's relatively easy to track. The credit markets behave differently sometimes, and it's good to be aware of kind of when that's happening. So the war in Iran, for example, we saw pretty extreme moves in some equities, for example, trading off. And it was the same with all of the tariff activity, about a year ago, where equity markets, traded off significantly. Credit markets didn't have the same reaction, right? They didn't trade off, as much. There wasn't the panic there. So, it is always interesting to look at both markets and say, oh my God, what's going on in the equity market? Oh my God, it's traded off 10%. It's in correction territory. Then you look over at the credit market, and hey, looks pretty benign. And sometimes that's right and sometimes that's wrong. You have to kind of take it, with a grain of salt. But I think with the tariffs, for example, it was an equity panic. Credit markets didn't panic. So it turned out that the market signal from the credit markets was probably a good one to look at and say, hey, credit markets aren't panicking about this. Maybe it's a good time to invest. And if you did that on that market correction last year, it was probably very timely.
Yeah, absolutely.
Yeah, it's a little bit the same with the war in Iran. The credit markets didn't really panic. So good thing to look at when you're thinking about, should I go back into the market or not, right? The reverse is also true. So you have to be aware of what's happening. Sometimes the credit market is a little bit slower to react, and if there is a huge event, sometimes equity markets trade off quickly because they're the most liquid, and people can get their money out quickest there. And credit markets are slower to react. So doing a full assessment where in the case of the tariffs, it was the right thing to buy the equity market on that dip last year. Pre-GFC, when the equities market traded off, credit might not have traded off similarly, but it was the right thing to probably get out of the credit market because there was a little bit more risk there that was systemic, and there was more downside in the credit markets. So it's not always true, but sometimes it provides the opportunity both ways. But it's interesting to look at both when you're looking at the market and trying to figure out where the market's heading in terms of managing your own portfolio.
Yeah, no, absolutely. Absolutely. No, this is really great insights, and we hope everybody listening is taking notes. We encourage everybody also to go back and listen to the show again, because a lot of times you can pick up some valuable information that perhaps you may have missed on the first go around. Is there, in terms of, what could be some of the, I guess, when you're looking at credit markets, some of the common investment pitfalls, and what strategies can you build around that to endure beyond short-term cycles?
I mean, look, there's lots of different strategies in credit. There's lots of things to trade. There's lots of different markets. There's the government bond market. There's your municipal bond market, corporate bond market. There's a real estate market. There's an asset-backed securities market. There's tons and tons and tons of stuff. It's a huge market. It dwarfs the equity market. I don't remember the exact ratio now, but multiples of the equity market in size. So there's lots of things to do, and some people trade within one market, so they become experts, let's say, in the asset-backed securities market, and that's all they do all day long in their whole career, and they find value every day or try to find value to outperform an index or just to make total returns. And some people trade between markets, right? They might say, hey, I like the corporate bond market now and I don't like the ABS market now. Some might go long the corporate market and short the ABS market, or long the corporate market and short the government bond market. There's lots of different things to do. I think it is complex, right? I think if finding a little niche to focus on from an individual perspective is probably the best way to invest as an individual. Again, you want some diversification across your old portfolio. Corporates are probably the easiest thing to understand. They're businesses. You probably track them, for your equity portfolio anyway. So that's probably, the easiest thing to do. At the same time, government bonds are probably the safest instruments to invest in. The lowest returning also, but the safest. So you don't have to worry about a lot of the things you'd worry about in other markets, about defaults and things like that, and not getting repaid, which you might have in corporate bond markets. So it's really about how much time and how much resource you want to put into it in terms of how deep you go. But there's a lot of expert managers that'll manage your money for you.
Exactly, and that was going to prompt my next question. Sometimes when things can be a little complex in this area, you don't want to be going into something that you're not too sure about. So I guess you got to do your due diligence on the types of people like somebody like yourself who've been doing this for a long time. It's always been good to have somebody like yourself by somebody's side if this is an area they want to explore and grow in, and having that person, because now they can, get a third party perspective on what's happening and how that aligns to what they're, looking to accomplish.
Yeah, no, absolutely, right. I think that should be the priority. What are your goals? What are you trying to accomplish here? That kind of thing. And if you look at a lot of investing frameworks, a lot of them say, just put your money in the S&P and don't worry about it. And in 20 or 30 years, it'll be worth a lot more than you started with. And they're probably right. There are some timing aspects to that. In the short term, you may want to manage risk a little bit more dynamically to include credit or fixed income in general. It really depends on what your goals are, how much time you have to commit to it, how much diversification you want or need. There's a lot of things. I mean, look, for small business owners, usually most of their assets are tied up in the business, right? And sometimes you reinvest for CapEx, for new equipment, for whatever, a new building, or to buy a business and things like that. There's a lot of money that gets tied up in that way. And sometimes some diversification is good, whether you do that in a 401k or, in an investment account or something like that. Sometimes it's good. And having a mix of equities and fixed income, is probably what everybody recommends in some way.
Yeah, no doubt. So, I take it like you mentioned, you talked about certain resources like the Wall Street Journal, and, there's other sources out there that can help, experts like yourself, so depending upon where people are and how serious they are about doing it on a personal level, how it can help their business, would it be safe to say that now's the time to be proactive, to start lining up those resources? Is there any particular thing people, and I know it's in the eye of the beholder, of course, so it's not one size fits all, but if you can maybe give some insights, what can people look for in somebody like you that could be like that confidant, that resource that understands this area of the market and helping them, accomplish their objectives in their business or from a personal perspective? Sure.
Look, I think there's a lot of experts in the industry, and a lot of people specialize in different things. So my career, for example, has been really focused on, the riskier part of the fixed income markets, right? And, that's a lot of distressed debt, restructurings, things like that. And what I try to do in those markets, in my investment strategy, is make absolute returns. So I'm trying to make 15, 20, 25% on the investments that I'm making. And if you're very knowledgeable, if you're connected to the market deeply, if you're in the weeds, as we call it, it's possible to do, right? And however, that might not align with somebody's financial goals, right? If somebody just wants some diversification from their equity portfolio, I'm not sure that that strategy is the best place to go. Maybe you want a government bond portfolio, right, where you get some U.S. government bonds and some UK and some European bonds or Japanese or something like that, and maybe that's enough to accomplish your diversification strategy. So again, it goes back to what you said earlier about what are your goals? What are you trying to accomplish? Look, if you're a huge family office with billions and billions of dollars, and you have the ability to invest in a lot of different strategies, a strategy like mine might make sense, right? Where you can put a little bit of money into it, earn some really great returns over time, or find some interesting things to do. Again, for diversification, for total returns, it depends what your goals are going to be. But I think defining your goals, once you have your goals, doing some research about who the best managers are for that type of goal. It's quite easy. Google or any of these AIs now will point you in the right direction in terms of managers that will help you there. If you bring up government bond fund managers, in any browser or in any AI, you'll get a list of some very competent guys. So pretty easy to do. And then there's various different vehicles to do it in: ETFs, mutual funds, etc. So you just got to pick your poison.
Absolutely. I guess might be a little off script with what you're talking about, but I'm curious to hear your feedback. Now with all this stuff going on with AI, because you mentioned AI, because it's a great resource, in terms of gathering information and intelligence, no doubt. But in terms of using AI outright, like to predict, like to pick and choose investments, you see them out there. Would that be a wise decision or probably not? Or use it with discretion and use it as a tool, but not rely upon it 100%? Because I've seen some of those people promoting that, AI will make the right predictions, at the right time and blah, 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 blah. But yeah, should be skeptical about that. But I'm just curious to hear your feedback on that.
Yeah, look, I think that the technology is still developing, right? And it's got enormous potential, and everyone reads the same things and sees the news just like me, right? I think finding a tool or an agent or whatever you want to call it that is a better predictor of performance in markets, or is better able to construct an investment portfolio over time. I don't know, right? I mean, these things are pretty recent, so. Using that is tricky. But I will say a couple things, right? So, there was a very specific investment strategy that I was looking at recently. It was in the insurance industry. It was in the reinsurance industry, actually, and it was managing a portfolio of reinsurance contracts. And the team I was working with had built this very complex model. It was spreadsheet based, very, very programming based. And it kind of went through iterations based on correlation between contracts and returns and predicted returns and things like that, and generated a portfolio that was technically on an efficient frontier, on an efficient curve, maximized risk return, right? And you could customize where you want to be on that risk spectrum. We built that model. It was very robust and great. We took the data, the input data, and put it into an AI, into one of the large language models, and we asked it to do the same thing. And it was pretty close in terms of matching our model. That's a relatively simplistic view because we only asked it to do two things, right? We said make a portfolio of the highest returns and lowest correlation among contracts. There's two variables, right? So that's just math, right? It's just doing lots of iterative calculations. So in that instance, it performed really well. It performed pretty much in line with our portfolio. But that's like a two-factor thing, right? And if you set it free on the equities market, without defining exactly what to say, I'm not sure it's the same way, right? So, yeah. But again, I think that is still developing. What I use the products for on a more day-to-day basis are efficiency tools, right? They help me research. They help me build a model. So sometimes, right? They help me build a spreadsheet sometimes that is a little bit faster than doing it myself. Some of these things are good at building, slideshows or presentation slides and writing documents and things like that. Sometimes, getting a whole bunch of data and pulling it into a very succinct thing it's very good at. So I think right now I view it as it's still very much an enabling technology rather than a replacement of any of these significant roles. But that being said, in certain circumstances, it performs well. So I'm sure it will continue to emerge. You just got to kind of wait and see. And
exactly. That's how I see it. Like it's a tool. Like you never depend on one thing, but you utilize tools that complement the things that you're doing. So, and then obviously, giving you enough information and intelligence to arrive at a decision what you're going to go from there.
Yeah.
Nothing is certain 100%, right? If that were the case, we'd all be rich.
I guess so, right? And or all poor, who knows? But no, I agree. And sometimes, managing a portfolio of investments, what I think is, there is a selection. You can select in different investments, right? Let's just say it's equities. I want to own Apple. I want to own Google. Okay. But going into that, there's a basis for which you're making those decisions, right? Whether you're conscious about that or unconscious about that. So, if you're going to say, all right, I want to own the S&P 500, you're making some big assumptions. One is, you're taking a lot of risk in US dollars. That's your main currency. Is that what you want? You're making that decision if you buy the S&P 500 that your investments are going to be in dollars. Sometimes you may not want that. Sometimes a manager, the way they add value is to say, actually, we don't want all dollars. We want some in euros or Japanese yen or something else, right? And that's what adds value to a portfolio. So unless you define a lot of those inputs up front for the model, for the AI model, it will take these things as assumptions. So, it's one of those things. It's a tool. If you give it all the assumptions that you're naturally thinking about or not thinking about, and give it a very specific task, it's great at that. But make your own assumptions model. Tough one.
Hey, so true. Wow, great insights with what you shared here. As we're getting near the end of the show, is there anything that we have not discussed or that you feel that is compelling and should be shared with the audience when it comes to what you're sharing about this topic today?
I think the biggest message for business owners and people like that is, just don't forget about the credit markets, or don't forget about fixed income. And if you get some news out that creates volatility, like we've had over the last month or two, and equity markets are down, it's on the front page of the, just ask yourself, what's the credit market saying? What's the fixed income market saying? Is it saying something different or not? And it might just lead you in a different way. It might give you a little bit more comfort that it's just some volatility, we need to ride it through, or oh man, this is really bad. We need to do something else, and maybe that helps them helps inform them a little bit on the background of what's going on in the economy to make better decisions. I think that's the biggest takeaway I would say for people is that don't forget about the credit markets. I think for a lot of guys who don't focus on it on a day-to-day basis, it's easy to forget them. And
it's not like something like might be top of mind, but I'm glad that we're doing this show to create this awareness that for any reason that somebody has, they can start keeping that more top of mind and finding out more information from people like you and how you can help them. Now, with that being said, as we're near the end of the show, I first want to thank you for taking the time to be with us here, sharing these valuable insights, not only from myself, but the rest of the team here at the Tal Radio and the Touch of Life Foundation. We want to thank you for being here. Wanted to leave this opportunity for you to share with the audience, how can they get in contact with you? What are you up to? And anything that you'd like to share or provide them here today.
Yeah, sure. If anybody wants to chat, the best way to reach me is on LinkedIn. Just search for my name. I'm happy to respond there. I have a website as well for my company. It's called thornwoodcap.com, www.thornwoodcap.com. My email's on there. You can email me as well. Look, it's an exciting time in credit markets. There's some news about, the private credit industry has grown quite a bit, and the market's trying to digest what's going on there. So there'll be some small opportunities around that part of the market. Overall, the economy has been pretty good. It looks like it's going to remain decent, at least for the next 6 months, as far as I can see. Depending on what happens in the Middle East, obviously. So not a whole lot of volatility and good volatility, I would say. If there is volatility, it's probably to take advantage of rather than be scared. But don't forget about the credit markets. They're sometimes very interesting, and they could provide you with a lot of insight.
Well, thank you so much again for being with us. We greatly appreciate you.
Great. Thanks for having me. Appreciate it.
Thank you. And listeners, we will make sure all of Daniel's contact information is in the show notes. So again, you could reach out to him directly. We encourage you to connect on LinkedIn as he suggested. And for any reason you reach out to us, we'll make sure to connect you to him as well. If you'd like to see content that we have not shared on this show, feel free to reach out to our team here at Chris at ChristopherSalem.com. We'd be more than happy to entertain for a future episode and bringing in the right subject matter expert to share their insights in that particular area. Till then, everybody, have a great rest of your week. We'll see you here next week, same day, same time. Take care.